Most traders use fair value gaps the wrong way, and this leads to massive losses. How do we fix this? Try this ultimate smart money fair value gap trading hacks and the result will blow your mind. Let's unlock the first hack. If you have a valid bullish fair value gap and price pulls back to it with an opposing bearish fair value gap, how do you know whether the setup is high probability or just a smart money trap? Most traders take a buy position immediately even though the bearish fair value gap is still unmitigated. More often than not, price will react slightly to the bullish fair value gap, tap into the bearish fair value gap and continue dropping to the downside, stopping you out. So how do you avoid this trap? Simple. The first approach is to wait for price to react to the bullish fair value gap and disrespect the bearish fair value gap. This confirms a shift in the market control from bearish to bullish. Once that happens, you can then take a long position from the inverse fair value gap targeting the next buy-side liquidity. The second approach is anchored on the smart money liquidity principle. The principle states that price sweeps internal range liquidity to gather enough momentum to push the market to the next external range liquidity pools. So, you wait for the market to complete the internal range liquidity grab, liquidate the external range sell-side liquidity within the bullish fair value gap. Once price completes the internal range liquidity sweep to external range liquidity cycle, most of the time price targets the opposite external liquidity range. So, if price reacts to the bullish fair value gap creating another bullish fair value gap, this opened doors for us to take a long position from the recent created bullish fair value gap, targeting the next external buy-side pool of liquidity. Let's look at some real chart examples. So here, we have Euro-USD chart. The market is bullish creating higher highs and lower highs. Looking at the last bullish leg, price broke structure leaving behind a fair value gap. We expect the market to pull back, mitigate the fair value gap and expand higher. Let's play the market forward and see what happens next. Price retraces back with a bearish fair value gap. This is the exact scenario we discussed in the fair value gap trading hack. We don't take a long position immediately but rather wait for confirmations. As the market moves forward, price reacts to the bullish fair value gap and disrespects the bearish fair value gap. This is a confirmation that price is willing to push higher. So, we take our buy position at the created market gap. Our stop loss goes below the recent structure low, and we target the recent structure high. Price pulls back to clear the remaining liquidity and then expands higher, hitting our target. Before we look at the next example, please give this video a thumbs up and subscribe so you don't miss our future videos. In this next example, price formed a bullish fair value gap and pulled back creating a bearish fair value gap. This is the exact example of scenario 2 we discussed in the fair value gap hack. As we can see, price swept the internal liquidity and then liquidated the external pool of liquidity. Consequently, the market broke out of this range creating another bullish fair value gap. With the buying pressure confirmed, we take our long position within the bullish fair value gap and target the next structure high. Price then pushed up hitting our target. Let's now turn our focus to a bearish market. Here, we have a market which has been pushing to the downside showing bears control. The last bearish leg created a bearish fair value gap. Price is retesting the supply zone with a bullish fair value gap. Looking closely at the current price level, the market has swept buy-side liquidity. We now wait for the market to disrespect the bullish fair value gap and create a bearish fair value gap. We can then take a sell position within the inverse fair value gap, targeting the next structure low. Price then moves as anticipated hitting our target. So, traders, whenever you develop a trade opportunity around fair value gaps, wait for a confirmation which can be internal range liquidity and external range liquidity sweep cycle. You can then take the trade targeting the opposite external liquidity pool. Secondly, you can wait for the opposing liquidity range to be disrespected before taking the trade within the inverse fair value gap. I hope you found value in this video. Please subscribe and share with us the next topic for our future videos. Thanks for watching.